Hello and welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Company Limited as part of the Investment Awareness Initiative of ICICI Prudential AMC. I'm Versha Jain from Outlook Money and your host for this session. Welcome to the first episode of this year in our series. If you have some surplus money, where would you invest it? Would you keep it in a savings bank account or a fixed deposit? Typically, people leave excess money idle in bank accounts as this seems like a safe and highly liquid option. However, there are alternatives that offer quick liquidity and returns at the same time. One such option is liquid exchange traded fund, or we can say liquid ETFs. These funds invest in secure and highly liquid money market instruments like treasury bills, certificate of deposits, commercial papers, and collateralized lending and borrowing obligations having a maximum maturity period of 91 days. Liquid ETFs are less risky than ultra short term fund and low duration funds in terms of interest rates risks because of their shorter term investment horizon. And that's why they are primarily used for parking surplus money, earning interest on it, and liquidating it anytime to reinvest in other schemes on the same day. While liquidity features the USP of this product, understanding how these ETFs work, how they differ from other ETFs, their utility as a parking avenue for surplus funds or as an investment tool, and determining who should invest in them is crucial. To provide insight on this topic, we are joined by Ms. Shradha Thakker, Lead Strategic Product Development, ICICI Prudential AMC, and Mr. Kaushik Ramachandran, Founder and CEO, Diota Solutions Private Limited. Welcome, Ms. Thakker and Mr. Ramachandran.
Thank you.
Hi, thank you.
So without much ado, let's start it. My first question is from you, Shradha. Please elaborate what are liquid ETFs and what is the primary purpose of investing in liquid ETFs?
So Varsha, as you've given the brief, liquid ETF is a product which allows investors to keep their short-term parking money, idle money into an ETF format, where the investments of these ETFs are typically into short-term papers, which is the majority of these papers are less than 1 day. So liquid ETF basically allows investors to have exposure to a highly liquid instrument because these papers are typically maturing in 1 day, which is also called as tri-party repo instrument, which is available on the CCIL platform for lending and borrowing. And liquid ETF, because they are highly liquid in nature, investor prefers to park their short-term money so that they can tactically allocate in equity market, because equity market tend to be volatile. They want to have a systematic investments in their equity investment. So liquid ETF as an instrument, investor prefers to have in their portfolio, where they can take those call and they can put their surplus money into liquid ETF. Secondly, liquid ETF is also used for the margin purposes. So the stock exchanges allows the investor to invest in equity instruments and keep liquid ETF as a margin product. So net liquid ETF is highly liquid in nature. Looking at the nature of investment where liquid ETF invest, they are low from a risk standpoint. And third is for an investor to have their allocation tactically into equity, they can invest their surplus money into liquid ETF.
Okay, so these are good for tactical allocation of the funds. My next question is from you, Mr. Ramachandran. Can you explain how liquid ETFs work in terms of buying and selling on the exchange, and how are these different from other broader index-based or thematic ETFs?
See, it's almost like buying any other stock. You have a demat account through which you can buy and sell through any broker. I mean, you need to have a demat account and associate with the broker, right? And any stock, I mean, since this is listed on the exchange, all the liquid ETFs are listed on the exchange, and it's just like the same process that you use for buying your stocks and any other stocks, right? And what matters is here is that while the price variation can be very wide, right? Volatile, it can change on a minute by minute basis. But when you look at the liquid ETFs, the variation, the volatility is not much, right? So typically, a NAV of a liquid ETF is 1,000, and it will vary between 999.99 to 1,000. So the volatility is not much. You just go and place the order and at the market price, and then you can buy these. It will get credited to your demat account. And when you want to sell it, I mean, you can again put a sell order in this thing. But the only thing you need to remember is it has to be sold in terms of, multiple units. I mean, units of, 1 units minimum. You can't sell a fractional units. You might get allotted a fractional units through dividend. Whenever you get a dividend, you might get a fractional units. That fractional units you can't sell, but you have to sell in whole units that you have to sell, right? So those are the things that, one need to take care of. Whenever I have to buy, I have to buy in whole units. Whenever I have to sell, I have to sell in, the whole units only. Place the order like any other, the stock purchases or stock sales that you do. And here the cycle is T+1. I mean, next day it will get credited to your demat account if you buy. And if you sell it, you can get the cash back in the, next day. And you can use it also as a margin, right? Whenever you want to quickly buy some stocks, and you can use this, ETFs which are available, liquid ETFs which are available as a margin. And you can immediately purchase a stock against these margin funds which are available, right? What is the second question? I mean, operational wise, it's same as a stock operations, right? Only thing is a T+1 cycle that we have to follow, and make sure that you're doing trading in the number of units that we have to do. If you look at the thematic funds or any other index funds, right? It's the underlying instrument. If you look at the underlying portfolio of a liquid ETF, it's predominantly bonds. I mean, predominantly it's only bonds, right? Or it will have some cash. But if I look at any other index funds or any other thematic funds, the holding will be stocks predominantly there, not the bonds. Here it is a portfolio of bonds, and other funds will be a portfolio of stocks. I mean, they're fundamentally completely different. ETFs and a liquid ETF and an index funds and a thematic ETF, so they're completely different in terms of what are the underlying investments that, the fund managers do under these options.
All right, thank you for explaining it in detail. Ms. Thakker, could you tell us what are the risks associated with investing in liquid ETFs?
So liquid ETF are considered to be a debt ETF, and it invests into a debt instrument called tri-party repo. Basically these instruments, the rate of interest has been disclosed on a daily basis, but the rate of interest has been impacted, as you all are aware, is based on the monetary policy which is announced by the RBI. So whenever there's a change in rate of interest due to MPC policies, or due to any event which happened into the global market, or there is a liquidity in case of a debt instrument where there is a volatility in the debt market, typically this kind of an ETF gets sensitized because of the interest rate movement. So being a debt instrument, debt ETF, it has a risk of interest rate, which is a core risk because it invests in the debt instrument. From a liquidity standpoint, if you see this ETF, as we discussed earlier also, these are exchange traded funds, and these are highly liquid on the exchange, where the investor can buy ETF at say 99.99 to 1000.01. There can be incidents or events where there is a limited liquidity on exchange due to a number of factors. So investor might get impacted of the liquidity risk of the ETF which is listed on the exchange. So these are the two inherited risks. One is from an instrument standpoint, where the liquid ETF invests, which is basically the interest rate risk. And the second important is on the exchange traded fund, the liquidity risk of an ETF. That is a second risk which is inherited in the liquid ETF.
All right, but here I guess we ensure that these are the liquid ETFs, so there should not be any liquidity risk as such.
Yes. So liquidity, again, from a liquidity standpoint, because the nature of instrument where the ETF is investing is highly liquid in nature. So there is no liquidity risk, you're right. But from an interest rate standpoint, the rate at which the interest which will be incurred in the ETF would be dependent on the interest rate risk.
All right, thank you. Mr. Ramachandran, what are the key benefits of liquid ETFs compared to mutual fund schemes or bonds?
See, the liquid, I mean, as first as a liquidity, I mean, you have better liquidity than, the mutual funds or the bonds, right? And if you go to the bonds, what happens is sometimes liquidating the bonds may take a lot more time, right? And, but liquidity is most of the time the fund manager guarantees that the funds can be liquidated easily, right? And duration, if you look at the other mutual funds, this thing, the duration of the underlying portfolio can be much longer. I mean, see here we are looking at liquid ETFs. We are looking at bonds which are duration of 1 day to about 91 days. So there could be the other mutual funds where the duration could be much longer. I mean, we have for mutual fund bond funds or the debt funds where the tenure of the OATM could be even 10 years. We may even have funds which are 30 years. So there are long duration bonds, right? But liquid investments predominantly their holding period will be less than 1 day. I mean, they will of course have some to generate the higher return. I mean, if you want a higher return in the funds, we take a little more risk, and the risk is in the form of duration. We take that up to 90 days. So while predominantly it will be 1 day tenure bonds, but we could have some 90-day bonds in the portfolio. And also, again, predominantly it will be 99.99%. It will be either cash or in AAA rated bonds in the liquid ETFs. The other liquid funds may take some exposure to bonds which are even low rated. I mean, low rated, as I said, I mean, instead of AAA, it could be AA plus, right? So where it matters is in terms of the duration risk, in terms of the credit risk that the funds are taking. So the liquid ETFs tend to be the least kind of risky among the other options that are available for investors in terms of short-term cash flow management, and also try to generate a little more higher return on that. You could keep your money in bank, right? That's probably the safest option that is available, which would give you only about 3.5%, right? And you could keep on the other side, you could have a liquid fund, where it would be giving you a 6.5 to 7%. So your ETFs will probably fit anywhere between your cash and your liquid fund, which are there, where the risk is little lower, and you might be probably getting a return which is lesser than a liquid fund, but it could get a returns which is more than the cash that you keep in the bank. Right, so that's where it fits in between the liquid fund and the liquid ETF fits in between the liquid fund and the cash. There are also the mutual funds also launch overnight funds. There are overnight mutual funds which are there. Okay, they would probably go a little, they're little less riskier than the liquid ETFs itself. So if you look at in terms of the risk and return, that you will see that the zero risk is your bank cash, and then you have the overnight funds, then you have the liquid ETFs, and then you have the liquid funds which are there. So that is how the the risk and reward equation work out in terms of these liquid ETFs.
All right, quite an interesting point that these are the midway of the savings account where one gets 3.5 to 4% of interest, and the liquid funds. So liquid ETFs somewhere lie in between. And this is an interesting figure. So 6.5 is not a bad interest at all in the short term. All right, Ms. Thakker, what factors can influence the returns of liquid ETFs?
Again, the point here is the interest rate. The interest rate is a major factor which can determine the returns. But if you compare liquid ETF to an equity ETF, because equity ETFs are more volatile in nature, it is dependent upon the underlying stock where the equity ETF is investing, and these are typically high volatile in nature, equity ETF. But if you see liquid, the movement in the yields is comparatively lower than the equity ETF. So the major factor which drives the volatility in the price of the liquid ETF is the interest rate. But if you compare with any equity ETFs, the volatility is far more lower than equity ETF. That's the reason it's a better structure to invest into your cash surplus, where you can invest your cash surplus into. And second, it is a very good option to keep your margin, to keep liquid ETF as a margin amount. So because of the low volatility structure, even the stock exchanges approve 100% margin to this particular product. So this is the USP of liquid ETF, where your volatility is far more lower than equity ETF. It is dependent upon the interest rate cycle in the country. And the third important aspect is the margin, which is coming through this ETF, allows investors to have a tactical allocation towards equity.
All right. So one of the most crucial benefit is the margin money, which one can get and use 100% of it in investing in other schemes. That's what
Yes.
I understand. All right.
Yes.
Thank you. Mr. Ramachandran, are liquid ETFs suitable for just parking excess funds or actually for investment as well? How do they fit into our investment portfolio?
See, when you look at an investment portfolio, the asset allocation is a key strategy, right? And everything boils down to the asset allocation. How much should I have in equity and how much should I have in debt? There are only two types of investment. If you look at it, any type, any form of portfolio, any form of your investment strategy, it involves, there are multi-asset. We also call multi-asset, but predominantly dominated by your stocks and the bond portfolio. See, the asset allocation is the core philosophy of any investing strategy, right? So for the low risk and the bond portion, the debt portion of my investment portfolio, right? There are many investments or tools which are available to me for maintaining that asset allocation for the debt portion, right? You have this liquid ETFs, you have the long-term bonds, and now I think many also use arbitrage funds because depending on the risk, they have the low risk options which are available, right? So among that, first is I need to have, as an investor, I should know that what is the allocation that I want to have in equity and what is the allocation that I want to have in debt, right? And when it comes to the debt, again, there are many options which are available, right? And the debt options are mostly taxed, right? The taxation of the debt investment is much higher than the equity. There we have a short-term, long-term capital gain. In the debt options today, I mean, we don't have to, the indexation is gone. We don't have any, options available, and it's a straight taxed at my income level, right? So there are options, there are debt options which are tax-free also, like a provident fund, which is a tax-free debt options available. So I need to have a mix of liquidity, long-term bonds, which could be, less taxing for me. So the tax structure becomes important whenever I look at the debt portfolio, this thing, right? And depending on the duration, when do I need the money? Do I need the money in the next 2 days? Do I need the money in the next 2 years? Do I need the money in the next 5 years, right? If it is going to be more than 5 years, then typically we start looking at equity as an allocation. But if my cash requirements are going to be less than 5 years, depending on the duration of my cash requirement, I can choose different types of debt instrument, right? And if my cash is going to be immediate, right? I want my cash requirement, it's going to happen in 2 or 3 days, or I don't know when it is going to happen. It can happen anytime. Then definitely the liquid ETFs, plays a role for that immediate cash requirement. And I think that as we've been talking about the margin funding, I don't even have to encash it. I can use the fund quantity available with me. I can just take a margin amount and use it for 1 or 2 days, right? So very short term to I would say less than 90 days is what the time duration that one can look at for holding these ETFs.
All right. So my next question is again from you is if parking is the only purpose, because this is the main purpose of parking
Yeah,
surplus money, it
yeah.
seems to be more suitable for high net worth individuals than a middle class person. Is it so?
Absolutely. I will definitely, agree with you. Ideally suited for high net worth individuals and also those who are frequent traders. If you look at the investing scenario in the country, there are more people who trade than who do for the long-term investing. So those high frequency traders, institutions who need the money for, just a short term, the amount is, the volumes are very large, right? It's ideally suited for them.
Right. They can utilize the margin money benefit more than the other
Correct.
person.
Because
Okay.
even a 1% difference between your cash and your investments can be, the quantum could be much higher. And also, for a short-term investor, the expenses could be much higher if I'm
Mhm.
going to, manage the ETF for a small amount of money. But if my, surplus is running into crores, definitely I'm going to, the operational costs are going to get, averaged and it's going to be much lower than what would happen for a small investor.
All right. Ms. Thakker, I want to know in details what are the tax implications of investing in liquid ETFs, though Mr. Ramachandran has thrown light on it, but I want to know more into the details and how liquid ETFs taxation is different from other ETFs.
So liquid ETF, because it is a debt, it invests into debt instrument, and after the recent budget, the indexation benefit, which was erstwhile applicable after 3 years of investment, now it has been just removed. So if the investor invests today in liquid ETF, he'll be taxed at his income level. So whatever is the income level tax, that would be the taxation for the liquid ETF, as compared to other ETFs which are there in the market. Typically, they are the equity ETFs, and equity ETFs are taxed based on the capital gains. So, equity ETF which are held for more than 1 year, there's a long-term capital gains of 12.5%. And there is a gold and silver ETF also in the market. So these are also taxed similar to equity ETF, where if a gold and silver ETF which is held for more than 1 year, the long-term capital gains would be applicable at 12.5%. So net, whatever is the instrument the ETF is investing, the taxation of that particular ETF would be similar. So for debt, because liquid ETF is investing into debt instrument, so the debt taxation, which is based on the income level, that would be applicable for liquid ETF.
All right, thank you for explaining it. Mr. Ramachandran, SEBI is working to reduce the settlement period to the same day, T+0 for stocks. Do you think it may be extended to ETFs as well, against the present system, as you also discussed, is this T+1? If yes, then why should liquid ETFs be preferred just for easy liquidity benefit?
Yes, experimental basis, the T+0 settlement is already there in the market. I mean, about 25 top market capitalized stocks are already available on a same day basis is available. But I think the volumes have been it's not been really great. In fact, it's almost dried up now, right? And then as a next level, they are planning to introduce this same day settlement to 500 top market capitalized stocks, right? I'm not seeing it's primarily meant for stocks and not for the bonds as such. So I'm not sure if it is going to be. I mean, I don't see anything, very near, the near term, like it's going to be extended to liquid ETFs particularly, right? And it's meant for stocks, settlement for the stocks and not for the bonds yet. And since liquid ETFs and other ETFs which may be holding the stocks, right? They may get after the second round of experiment where it will be first extended to the top 500 market capitalized stocks, and then may get extended to ETFs. But I think we are a long way off from now, right? And going by what has happened, I think there is a lot of promotion that is required. I think investor awareness is also required in terms of what are the benefits of T+0 settlement and all that. I mean, going by what has happened in the last few months, there seems to be, a lack of interest among the investors for the T+0 settlement. We are probably the first country which, if at all, we're going to have that kind of, faster settlement cycles. India is going to be, taking the lead there, right? We don't know how it's going to pan out, but I think for ETFs, it's going to be a long way. I mean, long time to come, right? And whether it is going to really benefit to the investors, I mean, which I don't know. I mean, it's not really sure of that.
All right, this rule coming to the ETFs, it may take a long way
Yeah,
as of
yeah,
now.
yeah.
Okay, my next question is from you, Shraddha. What should investors look for when choosing a liquid ETF? What advice would you give to someone new to investing in liquid ETFs?
So liquid ETF, while the investor is keen to invest in liquid ETF, the first important factor which the investor has to see is the expense ratio of the fund, because the expense ratio will in turn take into consideration the tracking error. So while investing in ETF, the major yardstick to evaluate an ETF is the tracking error. And tracking error is mostly dependent on the expense ratio. And looking at the nature of instrument where liquid ETF is investing, there the major proportion of the tracking error comes from the expense ratio. So the first and foremost important point is the expense ratio. And the second important factor which investors should consider is the track record of AMC, because these kind of a product, because they are available on exchange, and to maintain the liquidity of that ETF or the exchange, the AMC track record is very, very much important, because you know that the ETF market right now in India is still evolving. So there are market participants who provide liquidity on exchange. So if the AMC has a long-term experience on managing the market maker and the exchange liquidity, then there is an efficient transaction which can happen to the investor on the exchange. So two important factor: one is expense ratio, and the second is the AMC track record.
All right. So there are two factors, expense ratio and the AMC's track record. That's what we should consider while choosing one ETFs. And this is my last question from you, Mr. Ramachandran. What is the one key takeaway you would like our viewers to remember about liquid ETFs?
They should remember the risk and reward equation. As I said, it lies between your bank balance and your liquid funds. So if it is for the short-term duration, for less than a month, liquid ETFs are a better option than any other products that are available in the market today.
All right, thank you so much. Liquid ETFs offer the flexibility and to access funds whenever needed. In the debt category, they are ideal for parking idle cash, serving as an alternative to savings accounts, or function as a short-term investment option for diversification. Thank you, Ms. Thakker and Mr. Ramachandran, for joining us today and sharing your valuable insights. I appreciate the clarity and understanding you provided on liquid ETFs.
Thank you. Thank you very much.
With this, Investment Made Easy webinar comes to an end. Viewers, I trust you found the discussion engaging and enjoyed the session. Please don't forget to like, share, and subscribe to our channel and stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We'll be back with our next episode soon. Until then, stay safe and stay informed.